What is up? Good morning, ladies and gentlemen. It's time to rise and shred with the one, the only Jacob Gaffney. He looks so brilliant in the mornings, ladies and gentlemen. I just love hanging out with him first thing in the morning, Monday morning after a weekend. I just know that Jacob is always going to share some things that is just going to motivate us, going to inspire us for this week. And I mean, honestly, Jacob, last week, momentous week in so many different avenues, from billionaires to CFPB to Biden administration taking over. Like, holy cow, where do we even dive in? Where do we even start this morning, man?
I mean, we were sending out so much breaking news last week. It was crazy. I mean, even Dahl was like, oh man, come on, you're killing me over here. It's like,
you're killing me, bro. You're killing me. But it's true. There was so many big things happening. It's funny because there was one point in the week where you're like, okay, like we got to take a breath. Like, let's hold on. Let's find out what's going to break. And then we'll share it with the industry. But crazy week last week.
Yeah, it's crazy. And, it's like people talk about the news industry all the time and they got lots of opinions. And I get it. It's a public facing industry. You're putting yourself out there. People who disagree with the littlest things can write to you. They got a point. A point, right? You listen to them and all that. But it's interesting when you're sending out a lot of news and you're putting it all out there. It actually shows a lot of integrity on the part of a media company, which is why I love the work that we do. Because when you've been in news as long as I've been in the news, which has been forever, you learn that the bias. Everyone talks about you're biased. Yeah, well, you and I, we're biased, right? We're biased for the mortgage industry.
Right.
We're biased for promoting the mortgage industry, for promoting good players. We're going to start doing awards. We got all sorts of crazy stuff coming out this year. It's going to be huge for us, and that's awesome. And I love everybody. Thank you for supporting us, everyone. But talking about the bias, the real bias in media comes what you don't cover.
Yeah.
That is what people don't really understand is if you want to check your news source and you want to see if your news source is fake news, ask yourself, what are they not covering? Because if they are not covering an issue that everyone else has covered, that's their bias. That's where their money is. That's where their producer is. So when you want to judge someone, that's where you go with the bias. So that's the Monday morning. How do you do kind of soapbox off? Let's jump in.
Oh, I love that, because we truly do that, Jacob. That you and I have talked about this ever since we first started doing Rise and Shred. It's that unbiased, it's the real, it's the things that we're not taking aside. We're coming at you from a place that you need to know this information. And I agree. So let's start off. So CFPB, some big stuff happened in the CFPB last week. Let's start with that.
Oh man. Okay. So check this out. The CFPB previous director, Kathy Cranager, was a friend of my good friend, Pam Patno, who is assistant secretary at HUD and all that. And we've talked about Kathy a lot. Kathy was an apolitical leader at the CFPB. Like, of all the leaders of the last administration, she was very apolitical. You may think she was effective. You may think she was ineffective, but she was apolitical. That has changed. Okay. The new head of the CFPB, right? So Kathy resigned because she was asked to by the Biden administration. The Biden administration, the president rather, can fire the CFPB now because Trump made that happen. Before it wasn't like that. Now the president can fire the head of the CFPB. Now the president can fire the head of the FHFA, right?
Right.
He's not going to fire the guy he put in there.
No.
And the guy he put in there is an Elizabeth Warren associate. And the reason I say that, now, I talked to Elizabeth Warren when she was putting together the CFPB.
Okay.
And I said, why are you regulating appraisals? How are appraisals a consumer product? Why are you going to give consumer a voice in how appraisals are done? I'm not joking, Josh. I asked her this point blank, not as simple, much more simple. I said, let me tell you how I asked her. I said, Senator Warren, why would a consumer-facing protection agency look to regulate a tool used by lenders to determine what their collateral should be in a loan? Her response was like, if you don't break the law, you don't get in trouble.
Yes, that's true, I guess. That's very true.
And what followed, Josh, was years of bend them, but don't break them, monetary fines for mortgage lenders.
Ooh.
So mortgage lenders, as we saw last week, mortgage lenders got hit hard under the last administration, the CFPB, and the previous administration too, the Trump administration. They went after all those VA lenders. You remember Rise&Shred? They went after like
Yep.
They went after all these VA lenders. They just get on a tear. Look, we need money for stimulus. We need money. We need money for stimulus. Where are we going to get it? You're going to look at the industries that are making the money to siphon it from them. Okay?
Mortgage, baby. Mortgage.
I'm not making this up. This is what previous CFPB actions have done. So everyone needs to be on their P's and Q's because they are going to be actively going after you. And the new guy in charge, okay, he is an academic. He is not someone from the industry. He is not someone from a regulatory background, in as much as he's been in these kinds of roles before. And he has always been a dissenting voice in the previous administration. He don't have to worry about that no more, man.
Whew. That's kind of scary though, right?
He's got whatever he can go after. And if you look at Kamala Harris's background as as the AG, she has a history of going after mortgage companies too. I'm not saying these mortgage companies did right. I'm not saying they did wrong.
Sure.
I'm saying they're coming for you, and if it's not you, it's going to be the other person or the other person, but make sure it's not you. Now, on top of that, we know where the money is right now is in servicing. And everyone needs to, and I'll repeat it. Everyone needs to be really aware, if they have a servicing operation, that the scrutiny coming to servicing is going to be huge for all the factors I mentioned before, and the fact that the CARES Act will end one day. It will end one day. And that's when all the homeowners will come out and complain. And I'll say that again, it's the homeowners who are going to be driving the regulation. That's the way the CFPB is set up. When the CFPB started and all those monetary fines came, and a company that made $5 million was fined $4.5 million in the bend but don't break regulation environment that we saw last time, which is going to come now, where they're going to just take all of your capital that you have saved. They're going to take that, they're going to take that, put it in the treasury. Okay. I'm not joking, man. I'm serious.
Dude.
It's not like I'm joking, but I'm serious. But what they're going to do is they're going to look at the complaints to see who they could go at before they look at the bank accounts. And all of the complaints come from homeowners.
Holy cow.
That's where they start. All the complaints. They didn't start from the investors, right? It's not the investors saying, my bonds aren't paying out.
Right.
They're not going to Fannie and Freddie and saying, hey, who's not doing right over here. Every single payout to the CFPB generates at the homeowner level.
Holy smokes. Okay, so real quick, let's kind of taking this a step deeper. So does this really start to deter lenders? Does this start to deter people from servicing? Because ultimately, like if it is those ones who are servicing the majority, because the consumer, as soon as this CARES Act ends, we all know it's going to, eventually it will, complaints are going to just flood these servicers. So now our company's like, well, do I get rid of servicing? What are the thoughts? What's that?
No, I don't think so. I think the people in this industry are too right-minded. I think they're too good at what they do. I think they're too smart. If the responsible lenders and servicers out there are doing their job, they're going to continue to do it. It might slow things down.
Sure.
Right. It might add a couple of days to it, but for the most part, man, I mean, if you think back in your Rolodex, Josh, and you think of everyone you talk to, are any of them out there actually trying to deceive homeowners? They're not. So when you ask me generally, will our industry be impacted? No, it won't. But we will have these problems. We will have these problems because ultimately in our industry, people favor creating homeownership rather than walking away from it.
Right.
So, I don't think that mood changes. I just think that there's a new boss in charge. So we got to work the way they want us to work. That's and I'm just putting that out there right now. So we're not, on the show a year from now talking about someone we know who's paying $1 million settlement because right now the talent level is not trained up as well as it should be. And that's what we talked about last week, right?
Right.
It's like you have to have these hourly folks come in, trying to get them to do underwriting roles and all that, trying to get them to figure out. They don't even know the ins and outs. They don't even know what the CARES Act even is. Right. Half the time. You get an email from your servicer that says, you're out of the CARES Act, you're delinquent. Call customer service. If you don't call customer service, don't call customer service. You got to call Lost Med. You call LawSmith, you get someone on the phone there, they're gonna sort you out within 30 minutes. You'll be sorted out. They're gonna pick up the phone. You call customer service, you're gonna be on hold for 2 hours, and they're gonna tell you to go to the website to send an email. You're gonna send an email that's gonna tell you to call customer service. It's things like that just don't. It's the protocols, it's the logistics, it's the organization, and no one understands that they're like the way they're set up is for when things are going great.
Right.
Not
for when things are horrible.
Right. And so that's where we've seen the repeat. And the only difference between this and 2008 is we have a new CFPB that are going to be looking for money.
Period. End of line. So let me ask you this though, because consumers, 2008, 2009, when the crash actually happened, consumers did look to the broker. The broker community was the one thrown under the bus. Can we almost expect, as the CARES Act goes away, is it the mortgage industry who's going to end up with mud on their face after this is all said and done? Because technically, the CARES Act was put in place by the administration. When that all ends, it's the mortgage professional who's going to get hit hard. It's the lenders who are going to the ones who look bad, right?
The big difference here, Josh, is that investors have become increasingly more sophisticated as the operations at Fannie and Freddie, and you got to hand it to Fannie and Freddie for really rolling out tech. And we had some great leaders there in the last 10 years. I got to be honest, and I won't name names because I just end up leaving people out.
Sure.
But the investor community is sophisticated enough that they won't be sold these products, these poor products. Even now, when you look at non-QM coming back a little bit more this year, and you look at the pre-sale reports for the QM bonds, the non-QM bonds. The collateral is strong. You had people going into these bonds before that were underwater, and you had people when they were bundling up these securitizations, some of them will already reach REO. It was crazy, and they're going to generate excess spread off of that. Not going to happen.
No.
Right. So they're already underwater on the bonds. That's not happening now. We have a strong housing market now. I'm going to change my story. This hot housing market suddenly, becomes not so hot anymore. Well, then we have a problem. And we're not there yet. And all economic signs do not point to us getting there yet.
Right.
So again, I go back to the fact that as long as our industry is doing well and flush and making money, even Matt Ishbia said that he thinks 2021 can repeat 2020. I think that's crazy, but they know more than we know.
True. So let's go down that. While we're on that rabbit hole, I'd love to kind of jump down there. There's a new billionaire in the mortgage industry. Huge shout out to Matt Ishbia, personal friend of both of ours. And it's exciting to see. But let's talk industry wise. Mm-hmm. I checked their stocks this morning. They're still doing okay. They're a little bit down, but what does this mean as we start to see some of these, because again, we've talked about it in Rise&Shred a little bit. What does it really mean as we start seeing more and more of these companies go public? Good, bad, neutral? What are your thoughts on what it does for our industry?
I'm largely neutral with the stock industry. I don't mess around with stocks. I don't do that. The stock market for Rise&Shred is an indicator, a forward-looking indicator of economic strength. It does have to deal with, retirement funds, pension funds, and 401ks, which a lot of our readers and listeners, participate in.
Sure.
We look at it as a way to avoid, is there a crash coming, right?
Right.
That's how we look at it. Now, when you take a look at the way in which all these special purpose vehicles are being put together just to kind of launch our guys into space, it's really just a money grab, and it's there. So why not? You want to talk about the IPOs. Are there more coming? Absolutely.
You bet. Of course.
I think that, it's going to keep coming. And I think it's a great way to raise money. And we need it. We need to get the liquidity before we issued bonds.
Sure.
Right? In the form of subprime bonds. And that was the way we could get the money going back. And we saw where that led, right?
Yes, we do.
Where we just bonded every single mortgage we could write, and we looked for mortgages to write, we bond it. That's kind of where it is. Now we're issuing stocks. And that's the same thing. The difference is it's not private money, it's public money.
Right.
So you have to be a lot safer, and the collapse is spread out over a much wider net. And the stock market's liquidity is wrapped up again in the strength of the economy, not the strength of the market itself that it represents. That's the difference between stocks and bonds.
Right.
You got to think of where it's collateralized. So, it's not as dangerous for us to be doing this right now in the mortgage industry, to be launching these IPOs. There's just too much upside to it. And frankly, I think I feel more comfortable having more billionaires running our company.
I agree.
Because when Jamie Dimon dropped the S-bomb last week talking about fintechs, he wasn't talking about the non-billionaire payments companies. He was talking about Apple. He was talking about Amazon. He was talking about Google, right? How many billionaires run those companies? Those are billion-dollar companies, right? And that's what's got them scared.
So for those who missed that story, we titled it in here, SBombs. For those who didn't catch that, explain that, go a little further into that.
Yeah, so Jamie Dimon did a bunch of things last week. Jamie Dimon is the CEO of JP Morgan, and he's a little bit more of the outspoken kind of, we quote him a lot because he's a colorful guy. Also, he puts information out there, and he likes to talk, and we like to listen.
We do.
So he dropped that he was scared S-less of fintechs and progress. And he dropped that in a call with investors. And he also sent, and I've learned this morning, he also sent a list of companies that he finds threatening to kind of his management. So that was one thing I didn't know, that he actually dropped the S-bomb. It was not this extemporaneous kind of like, I'm a colorful CEO and I'm going to mix it up a little bit and drop an S-bomb. He's actually serious. He wants a strategy for fighting fintechs.
Yeah.
Especially in the payments area, which is something in mortgage that we're getting closer and closer and closer to. And we're learning more and more and more that the way in which we aggregate data, distribute it, and accept our payments is going to be the future. So the way in which we digitally close, the way we digitally valuation everything, we're moving away from the property and beginning to go after the actual money and the way money works in our industry with the fintechs. And those are the successful ones that kind of, because the money, home buyers don't understand buying homes.
No, they don't.
But they understand money.
Exactly. Bingo.
So that's where our success is. That's where our future is. And it's got the big banks scared of us and what we can do. So and I know for all the Apples and all that, we've got the Plaids. You go down the line with all of them. And again, I don't want to name names because I'm always afraid who I leave out.
Sure.
But there's so many awesome fintechs in there that he should be scared. He should be scared. And he thinks he's going to win, and he's not going to win.
Dude, I totally agree with 100% agree. And that's the way the industry is moving. It's exciting to be part of it, to see it. Again, like you talked about, you've been doing this for so long, seeing all that you have. It's probably exciting. Again, I've been doing this just over 10, 11 years now. You've been doing it way longer than I have. You've seen so many of these things, and seeing a turn of events like this, starting to see that evolution that is happening within our industry, seeing the fintechs take, kind of a front role, kind of a front seat to this whole entire thing and leading the way. It's exciting. And I think companies like JP Morgan, like we got them on their heels. So it'll be exciting to see what happens.
I don't think they can pivot. I mean, I don't see how. The only way in which a big bank or any large investor at this point, or even the big guys, is they have to pivot through interactions with vendors. It's going to be the only way. And that's where they're going. I mean, I think the big CEOs right now spend all of their time speaking to vendors. It's
true.
It's the only way, man. You got to buy. Can't build. Too late to build. Got to buy.
Ooh, got to buy. That's a good place to start wrapping things up. Got to buy. It's not time to build. So, Jacob, things to come this week. Again, last week was a very eventful week. Anything we should be expecting or watching for? Again, guys, if you haven't subscribed to Rise&Shred, the link is below. Make sure you do it because you don't want to miss a single day of all that we're dropping here, the team at Rise&Shred. But what things to look forward to this week, Jacob?
I mean, we're going to be looking at some IPOs from other lenders. Look to be going out this week. We'll see. I'm really curious to see the first action of the CFPB as an indicator of future action. So that's really what I'm focused on. Speaking of payments, PayPal has shut down the account of our friend Jenna Ryan, who went to the Capitol, who works in real estate. So we'll be writing a little bit about her plight and just talking about that kind of behavior because it's interesting. And we'll be looking at that, man. And things are moving so fast that what I'm telling you today is almost definitely going to be irrelevant come Wednesday. So you got to check that email every day.
Every single day. Check it out. Rise and Shred every single day. You can subscribe below. We have that link. Jacob, as always, man, it's a great way to start Monday. So exciting. Like I said, big week last week. You never know what's going to happen tomorrow. So that's why you've got to tune in. But brother, as always, I appreciate you hanging out with us this morning, sharing the expertise and knowledge that you do. And guys, tomorrow, Rick Sharga is on the show. We're talking about foreclosures, the moratorium of foreclosures. You're not going to want to miss tomorrow morning show with Rick Sharga. So make sure you tune in there. Jacob, always a pleasure, brother. Thank you so much for joining us. Guys, again, click below to subscribe. We appreciate you guys being here. We love you. Now it's time for all of you to go shred, go show up, hustle, repeat every day. See ya. Hey, what's up, everybody? Thank you again so much for joining us for today's show. If you like the content, make sure you hit that like button below. And if you already haven't subscribed to our channel, click right over here and you can subscribe to our YouTube channel. And if you want to see our latest video, click over here. And again, if you want to see the best of daily content within the mortgage and real estate industries, you have to subscribe now. We look forward to having you shred with us every single day.